We're here in Monte Carlo for the Rendezvous de Septembre. For Invest TV, I'm Richard Banks. And I'm joined now by Tim Gardner, Global CEO at Lockton Re. Tim, it's great to have you back with us.
Hey Richard, how are you?
Very well, thank you. Very well. All the better
Good.
for seeing you.
Yeah, thank you.
Buoyant mood generally in Monte Carlo this year. What are the sorts of conversations you're having?
Yeah, I mean, I think it's easy to be happy when everyone's making money, right? It's a good environment. I think our insurance company clients feel good about where they are in the world and their business, and reinsurers have obviously made some great strides over the last 2 years to get back to meaningful profitability. So yeah, I think it's been a quiet conference in terms of dramatic issues to try to unpack. You know, somebody said it to me well, that we're not really tackling things that we haven't been dealing with for a number of years, and so I think that means it's a little bit of a vanilla flavor to the conference, but vanilla is okay. You know, it's been meaningful and productive.
And good, reasonably good times. How sustainable is that?
Well, I mean, you can already feel pressure building, right? And back to back, if you just take the property cat space as an example, back to back of exceedingly profitable years are definitely going to lead to some pressure. We still obviously have to get through the hurricane season, but assuming we do with reasonable loss or no loss activity, it's fair to assume that reinsurers are going to bank very considerable profits. They obviously did through the half year. And so we think there's going to be pressure coming to cat rates. But it's been a very good ride for the last 2 years. And even with a little price softening, we still think it's a good market for reinsurers to support.
So Invest has a positive outlook on the reinsurance segment, in part due to the way that reinsurers have been adapting their risk tolerances. You've talked a little bit about your clients, about the insurance companies. Are cedents getting the coverage that they want? They feel they're being treated well?
Well, the challenge is the bottom end of programs, as you know. If you go back 2 years ago, there were three main moves that the reinsurers made. One was price, obviously. Second was to tighten up terms and conditions, so the covered perils were reduced in scope. And the third was retention levels. So yeah, there has been some pain certainly at the bottom end of programs, and I know our clients would love to find cost-effective solutions, whether those are occurrence protections or aggregate. Both would be welcomed. The question is, can we find the capacity, and can we find it at prices that are acceptable? But it will absolutely be a higher topic this year, at the end of this year, as much as it's ever been.
So at this stage in a hard market cycle, one might expect to see new startups coming into the market. We haven't seen that this time. Firstly, why do we think that is? But perhaps more importantly, what are the long-term consequences of that?
Yeah, I think there are two reasons for it. The first is that capital is finding ways to support our business without new co-creation. So you see a lot through investment vehicles and sidecars, et cetera. So they are finding ways to support the business without the fixed infrastructure of building a new co. And the second reason is the returns haven't been that great over a long period of time. You know, it's easy to look at the last 2 years and think how profitable reinsurers have been, but the prior 6 weren't all that great. And I think there's a concern about the sustainability of the profit levels, and we're obviously entering in a world where there's more volatility. You can certainly see that global warming is a concern for folks. So all of those, I think, factor into the mix at the investor profile. If they can get in and support the business without forming a company, that may be, at least in the near term, a preferred path. And we are starting to see some activity around new company formation, which is exciting. It's good to see.
So we are here, as ever, in the midst of the hurricane season. It's supposed to be a more active, a more intense hurricane season than usual. We haven't necessarily seen evidence of that yet. But if there were to be a capital depleting event, how eager are investors going to be to come in and reload, do you think?
I think they're there. I mean, there's plenty of capital in the world. There's plenty of capital eyeing our space. If the right series of events and the right circumstances came together that made the returns attractive, I have no doubt there's capital that can come and fill it. The form it does that will vary. And I think we've seen that. It hasn't necessarily been new co-creation as the flavor over the last 18 months, but that could change. I think you have to adapt to whatever losses occur and what the market opportunity gives you.
Tim, great to talk to you as ever. Thank you very much indeed for your time.
Thank you. Always good to see you.
For Invest TV, I'm Richard Banks.